All right. Okay, so welcome to week 3. We are cruising right along. To me, the week that we are covering tonight that y'all have read over the week is one of the easier. There's some important stuff in it, and we'll kind of highlight that as we go. And then there's some that's just like, there was 7 pages worth of not much material there. So, you just kind of have to learn how to pick and choose what's important and what's less important. And we'll kind of, like I said, highlight that as we go. But no, it's a pretty easy going week here. So yeah, let's check it out. So we got as you can see from the notes I took on this, I think 7 pages worth of content on the Government Accountability Office. I didn't see a whole lot worth taking note of. That doesn't mean it wasn't important. It just means it's logical sometimes. It's like, okay, it's repetition of what we've seen in other stuff, or it's just like, I don't see why I need to take notes about this because I know it when I see it type thing. So really all I kind of put down here, and also sometimes it's like, sometimes they're giving you a little preview of something that they'll cover in much more detail later. So sometimes I'll take less notes at that point and hit it when they get it harder later. That's the case with this section. So the thing I did take note of was that the GAO guidelines apply to those who audit government entities or entities that receive government awards, such as colleges and charities and that kind of things. And it's all in compliance with generally accepted government auditing standards, GAAS. So that's all I saw worthy of taking note of right now. Government auditing standards tends to be the basis for most of the relevant questions on the CPA exam, and there's a big section toward the end of the semester on that. So we'll hit it at the appropriate time then. And the GAO, by the way, is the one who publishes the government auditing standards publication. So basically, hold that thought until we hit that section. That's about all I really know to say at this point. On the, it's going to drive me crazy. I need the questions to be on the other side. Yeah, I can get used to it. Okay. As far as the questions go, just to give you an idea of kind of what we are learning at this point on this, it's very basic stuff, right? Number 1 says the GAO's independence rules for auditing apply when SAM audits which of the following. So that's really not so much a question about independence. It's a question of what does the GAO govern, right? So our answer would be one where do the GAO rules apply? You said it applies to audits of governments or entities receiving government funding. So it doesn't apply to companies or things like that. So it would apply to this county in Arizona if we were auditing that county. It would not apply to IBM or the corner store. So basic stuff. That's kind of our takeaway at this point, right? 2, I didn't find to be that important. And then 3 and 4 kind of test things we've already learned from other sections. They just kind of have it in a different setting, right? So yeah, our person of interest in number 3 is the city of Fairluth, but the idea about how to answer this is built. It's all the independent stuff, right? So the city's internal auditor became ill, which created some difficult situations. The auditor is the mayor asked the person who audits them to temporarily help prepare the city's basic financial records, and he did so. Later, he and his team audited those records. So in your head, you're thinking, oh, this is definitely not allowed, right? You can't audit your own work. It doesn't matter if what you're auditing, right? Later, he and his team audited those records and pronounced them fair and accurate. And they probably were. Nonetheless, is it possible that we have an independence problem under the GAO guidelines regarding non-audit services? Of course, right? I mean, doesn't matter whose standards, that is a problem, right? So A, throw it out, B, throw it out, D, throw it out. It's obviously the only one that says yes. There's no safeguards that can be put in place at that point. You have prepared something and audited it, and you're just kind of sunk at that point, right? So that's more of an independence question rather than a GAO question, right? Number 4, which of the following services would constitute a management function under GAO standards and result in the impairment of the CPA's independence? So it's again another independence question, right? Okay, I was looking, I was like, for some reason I was looking at my page wrong. I'm like seeing a D, but it's not D, it's A. And that's exactly what I have written down. So evidently my eyes are playing tricks on me. You obviously can't develop policies, right? You know, yeah, you can provide advice on methodologies, you can provide opinions. I guess D would be the next choice if we didn't have A on there, but here you're still kind of advising on routine things more so than A. A's the worst one for sure. Developing policies. Recommending procedures is not that big a deal. So there you go, you get the point. Not a whole lot of takeaway from the GAO section. The Department of Labor section is a little more meaty, but not much. So when we are talking about Department of Labor, what do they do? Well, they're going to regulate the employee benefit plans, the audits of those. The Department of Labor, it's kind of neither here nor there, but they have not adopted the same rules as the AICPA, but they're pretty much all common sense stuff. What they have actually done is the rules they have are really old, and they mirror older AICPA rules. So these rules for the Department of Labor are a bit outdated, really, but they mirror pretty much old AICPA rules. Common sense type stuff. So it's not anything to worry too much about. I've noted the things that are a little bit unusual. Really all you need to take note of, in my opinion. Specifically, things to mention: independence problems come about when you're auditing a plan in these cases here. You already know this. No member of the firm can have a direct financial interest in the plan. We've mentioned that when we were talking about financial interest and independence, right? And they can't have a material indirect financial interest. So that is not new information. We've already talked about that. This is newer type information, I guess. You can't be a promoter. It's not really, though. We've mentioned this in passing. You can't be a promoter, underwriter, investment advisor, voting trustee, director, officer, or employee of the plan. We've captured those ideas and other things we've said. You can't advocate for an audit client and that kind of thing. So that's, again, not really new information. So this bottom one's really the new-ish information. You can provide professional services, including actuarial services, without ruining independence. So the rules are a little bit looser in this area. So you could take note of that, and I highlighted in green there. Independence would be impaired if you maintain financial records for the plan. So you'd be auditing your own work, right? That's pretty much the takeaway. I looked, and I usually cross-reference the other test prep companies too on these sections. This one seemed a little, I don't know what to focus on, so I went and looked at some of the others, and looking at Becker, they pretty much cover what I've noted here. You know, in a nutshell, what we have is the Department of Labor has the guidelines for determining if you're independent to give an audit opinion for an employee benefit plan. We already said that, right? So independence is obviously required. We would know that. And then they mentioned in Becker that you're not independent if, and they listed the whole same things that we have here. Can't have a direct financial interest, can't have a material indirect financial interest, can't be underwriter, promoter, all this stuff. And if someone at your firm maintains the financial records for the benefit plan. And then they mentioned in Becker that you are okay if your firm rendered actuarial services. So Becker notes the exact same things that I kind of highlighted here. So that's pretty, you know, that tells me this is the takeaway, and I wouldn't worry about much else. That's my opinion. So know that any of these we need to specifically look at. I'll tell you what I just realized is I forgot to look at the notes any of y'all left on this week's Excel spreadsheet. Okay, so let me tell you what happened and why I have not been able to do that. A pipe burst in the ceiling above my office, and my office got flooded. And I am not in my office right now because it is wet and stinks and things are ruined and it's just a mess. So yeah, I'm without an office right now. And my computer, one of the other professors rescued it from the water that was what they are described as like a waterfall coming out of the ceiling in my office. Ceiling tiles are on the floor and everything's soaking wet. Yeah, I am displaced at the moment, so bear with me this week. Yeah, that's been difficult. But yeah, I don't think any of these are worth looking at unless y'all want to catch my attention on any of them. Happy to look at any of these. They're just kind of same old thing that we just kind of said. Pretty simple stuff. Maintaining the financial records, and all of these. It's just stuff that real simple things that we've already mentioned. So please don't pass those. Yeah. So that was a big chunk of your page numbers, right, for this week. So that kind of made it a little easy. So now we shift gears into actually getting into the auditing stuff now, right? You know, everything we've done so far has been code stuff, and independence and junk like that, ethics, code of ethics and stuff. But now we're actually going to talk about auditing and shifting gears quite a bit at this point. We're getting past these rules. So this goes pretty easy. There's some really important stuff in here as far as the CPA exam goes, especially in this next section with all the generally accepted auditing standards and principles. That's heavily tested. As far as this little section goes, this is just the most basic stuff. You should be able to say by heart what an audit does. You are auditing to provide financial statement users, investors, creditors, whoever, with an opinion by the auditor. And the opinion is going to be whether the financial statements are presented fairly in all material respects in accordance with GAAP. You should be able to recite that. That's extremely important. And part of the report. So it's just, that's the type of language you'll see over and over again. And you'll see it in test questions. And it's super important. So just be ready to say that. The financial statements are presented fairly in material respects in accordance with GAAP. Or some other framework, but just say that, it's fine. And obviously, we're given an opinion so that people can have confidence in what they're seeing, right? obvious. So that's the purpose of all of this. And then it just kind of goes into who sets the standards for GAAP and who sets the standards for auditing stuff. That's important. You probably already know it, maybe not the federal stuff, but you know, FASB and GASB. So the accounting standard setters are FASB. We know that. They do all this junk we're having to learn in Intermediate 1 and Intermediate 2, and we're very familiar with that. GASB, so that's the governmental standards. And then Federal Accounting Standards Advisory Board has federal government stuff. We don't run into that a whole lot. So FASB and GASB we're really familiar with. Okay, but this is an auditing class. Who sets the standards for the audits of those types of entities? So for governmental entities, we already know from a second ago that they're set by the GAO. And what those auditing standards are the generally accepted government auditing standards. If you're auditing, you got the PCAOB who sets those auditing standards. And then for the private companies and other entities, you would follow standards set by the AICPA, specifically their Auditing Standards Board. And that is generally accepted auditing standards, which we unfortunately call GAAS. So, yeah, GAAS. And that's it for that section. I think there was one multiple choice question there. Which of the following is not a primary responsibility of an auditor? And it's the only difference in each of these is, are we providing regulators, creditors, management, or investors with an opinion? That opinion is for whoever's using these financial statements outside the company, right? So we're not providing management with an opinion. It's not really for them. It's not our primary responsibility. Auditors are serving the public. So that was our question from that. A very introductory section there. This section's got some stuff though. Things have changed since I learned auditing back when I was in college myself. We used to have generally accepted auditing standards. There were 10 standards that made it up. And we, in my class, had to memorize those word for word and write them out word for word. And that was one of the most useful things I ever had to do, believe it or not, because knowing those 10 standards by heart helped me answer so many CPA questions. I hate that they changed it. But those 10 standards they still are applicable, honestly, but they've replaced their little framework with 7 principles now. But now, you know, GAAS, generally accepted auditing standards, used to refer to those 10 principles. Now GAAS refers to all of the statements on auditing standards, which we call SASs. Okay, so these standards, these principles rather, are not requirements, and they don't have any authoritative status, but they're intended to be a framework type thing. Every single word to follow is important. So learn this. It is important stuff. You're going to get a lot of good content about a lot of good things here, because this is the framework that kind of all the SASs and interpretations are kind of built off of this framework. So this is all important stuff. So there's 7 of them. We've got the purpose/premise. None of this is difficult stuff, but it's all important stuff. It just gives us good conceptual stuff. So as far as the purpose/premise thing goes, it tells us what the purpose of an audit is. The purpose of an audit is to provide financial statement users. We're seeing that same language we saw earlier about, last section, blah, blah, blah. So we're providing financial statement users with an opinion by the auditor on whether financial statements are presented fairly in all material respects in accordance with GAAS or some other framework. So completely repeating what we just said. Why do we want this opinion? Because it enhances the confidence that these investors and creditors and potential investors and potential creditors and regulators and whoever's reading these, they have more confidence in it. That's the whole purpose. Okay? Very, very important. An audit, we're supposed to conduct our audits in accordance with GAAS. The one that's in accordance with GAAS is conducted on the premise that management, and we're getting into the heavier language here, so you can kind of cut some of that off and just say management if you want to. In the standards, they have to say management, or those in charge of governance have responsibility for management's fine. That covers our purpose. So our audit in accordance with GAAS is done so on the premise that management has these responsibilities. All right, management responsibilities, very important for test questions. Auditor responsibilities, very important for test questions. You'll see it time and time again on these management responsibilities. They are the ones who are responsible for preparing financial statements. They're the ones responsible for fairly presenting financial statements. They're responsible for designing internal controls, implementing internal controls, maintaining internal controls, all of which are relevant to fair presentation of financial statements. Because those are supposed to catch, before they hit the financial statements, any potential errors or any potential fraud. Management's responsible for all of that. Auditors are just checking it, to put it simply. Okay. Auditors aren't doing any of that stuff. Auditors aren't responsible for fair presentation. They're not responsible, obviously, for preparing. They are just giving an opinion. Very important. And you probably already know this. Okay, so that's an extremely important management responsibility that you'll see time and time again in the auditor's report and everything. Management also is supposed to provide the auditor with the stuff they need. It's pretty obvious too. Records, documents, anything relevant to the preparation and fair representation of financial statements. Any additional information the auditor may request. Unrestricted access to things the auditor determines necessary to obtain audit evidence. So that's management's responsibilities. Their responsibilities are the financial statements. We are responsible for checking them, right? We, the auditors. So, in doing what, so that's all the purpose and premise of audit. That's the first standard. Second one is responsibilities. Just tell something real simple. Auditors are responsible for having appropriate competence and capabilities to perform the audit. That's obvious stuff, but shows up time and time again. Auditors are responsible for complying with the relevant ethical requirements, which we spend a lot of time talking about. Bolded and underline this next one because it shows up time and time again. Auditors are responsible for maintaining professional skepticism, which basically is you're not being all suspicious of everything somebody says, but you need to have a questioning mind about anything. Don't just take somebody's word for something. Check it, right? You want to gather evidence to support the things you're seeing. You want to always be looking for risk areas and always be like, yeah, that could be something they could be kind of tweaking there. We should gather more evidence on that. Right? So we're responsible for maintaining professional skepticism. You'll see that phrasing a lot. And we also have to exercise a lot of professional judgment. We'll find that out as we go for sure. So we got to do all that during the planning of the audit and performing the audit. So we got to be competent to do it. We got to comply with the ethical requirements, and we got to maintain professional skepticism and exercise professional judgment. That's the second one. Third one, performance. A lot of stuff under this one. But some very important stuff again. To express an opinion, the auditor obtains, very important, reasonable assurance. Reasonable assurance, not absolute assurance. Okay? We're not going to test every transaction. And there are things that you just can't catch everything. So we're going to obtain reasonable assurance about whether the financial statements are free from material misstatement. Not absolute assurance. So any test question you ever see that says we're doing all of this, 100% of this, and we're going to make absolutely sure that everything is 100% fine, that's not the right answer. Reasonable assurance, not absolute assurance. And that assurance, we're responsible, and we'll talk about fraud later, but our goal is to make sure the financial statements are free from material misstatement. And those misstatements could be caused by errors or by fraud. So I'm trying to make sure there's no misstatements, regardless of what they were caused by. So how do we get this reasonable, which is high assurance, but not absolute? We have to plan the work. We have to properly supervise anyone who is assisting. We have to determine the appropriate materiality level, because we're not worried about immaterial things, but we got to figure out what we think is material versus immaterial. And materiality levels is another reason we can't give absolute assurance. We give reasonable assurance. And we got to identify and assess risks of material misstatement, which means we've got to understand the entity and its environment and its internal control. We got to do all that. But we can't have absolute assurance because there are constraints to this, right? Just the pure nature of financial reporting means something's going to go wrong, probably. You probably won't catch everything every time. And audit procedures aren't designed to catch everything every time. And we don't have just an unlimited time to do this. We've got to get it done in a reasonable period of time. So that can be a constraint too. All right. That's the performance principle. Reporting, this is pretty easy. Based on an evaluation of audit evidence obtained, we've got to express an opinion. That opinion will be in the form of a report. And we'll state our opinion, or we may not be able to render opinion, and we'll have to state that we weren't able to do it. And that opinion will be whether, there's that again, financial statements are presented fairly in all material respects in accordance with GAAP. So we will do all of this. All right. So there you go, there's everything. So our first category is 1 and 2. Our second category has 1. Our third category has 3. And our fourth category has 1. So there's our 7 things. Very important section for sure. They didn't give us too many questions, but it'll all show up as, this is very broad stuff that covers every section of the book that we're going to cover. So these ideas will find their way in the questions from any section to follow. But what they gave us, number 1, according to generally accepted auditing standards, which of the following terms identifies a requirement for audit evidence? Appropriate, adequate, reasonable, or disconfirming. So I feel like this question doesn't belong here yet. In fact, I feel like it's kind of misleading to be here. It's based on what we've been seeing, we might want to answer reasonable here, but when you get, and you'll see this later in the semester when we start talking about audit evidence, I keep saying all this common phrasing that you'll see. One of the common phrases you'll see is sufficient appropriate audit evidence. So sufficient appropriate audit evidence is just a phrase that is very, very common. So the answer to this is A for audit evidence. Like I said, we're not quite ready for that though. Better later. I want to point that out in case that threw anybody for a loop a bit. Another common phrasing that you'll see is adequate technical training and proficiency as an auditor. Adequate technical training and proficiency as an auditor. So number 2, you'll be able to answer better later than you are now probably, but B is the answer. As you get familiar with this same old phrasing over and over again, this type of question will come second nature to you. But it says an independent auditor must have which of the following? They should have adequate technical training and proficiency as an auditor. Technical training that is adequate to meet the requirements of a professional. They don't have to have a pre-existing point of view with respect to the audit. They can develop their point of view later, right? They don't have to have a background in many different disciplines. They don't have to have experience in tax. So you could have answered this either way, but that phrasing is very common. The exercise of due professional care requires that an auditor do what? And this kind of gets at the whole idea of reasonable but. So do we examine all available corroborating evidence? No, that would be impossible, right? It's always a good wrong answer when they say do all of this, right? Critically review the judgment exercised at every level of supervision. That sounds right, doesn't it? Reduce control risk below the maximum. We are not ready to speak to that because we haven't talked about control risk and all of that. So this question is getting a little ahead of us. But that's not an entirely wrong answer, but it's just a little too broad and indirect to be a good answer. B is the right answer. We'll talk about this type of thing a little later in the semester. These questions got a little ahead of where we are. I'm going to go through these and point that out. I'll put a star by each of those to make sure I mention this. But do keep in mind, these questions are there for you to learn from. That's their purpose. So don't get frustrated ever by these. Just take the new information and incorporate it into the things you're learning. You'll be good. You'll see it all again. So not too worried. Okay. Very important section. Not a whole lot of meat to this one. It's called professional standards. Just gives you a little more about the way the standards are set up and some of the language that's used within the standards. Statements on auditing standards, that's what makes up GAAS. They have to be followed by auditors most of the time. So we need to have sufficient knowledge of the SASs. When would we ever not need sufficient knowledge? We should be prepared to justify any departure from those. And then materiality and audit risk would underlie us being able to apply the SASs. Something that'll come into play with later sections as well. So you got the SASs, those are the things you have to follow. More about that here in a second. But there's also interpretations to the SASs. Those are not auditing standards, but if you don't apply their guidance, you should be prepared to explain yourself. So explain why. And then back to the standards. So there are, and this little part right here does show up in test questions. And they're kind of nice and easy, but there are unconditional requirements in the SASs. You've got to comply with those no matter what. And the language in the standards will say that you must do this. Must do it. So those are unconditional requirements. Must means you must. And they get really fancy with their language here. Presumptively mandatory requirements. So these are just a little less than the musts. The standards will say you should do this. It's not you must, but they're like you should. And to expand on that, it says there may be rare circumstances that you can depart from these, that you've got to document and justify why. And then there's some that you can do or do not. It doesn't matter. These are just material. There's no requirement. You say you may do this, you might do this, you could do this. It's like if you wanted to, if that would help your situation, you could do this, or you might do this. You know, if the company you're auditing does this, you might do this. You know, so that's the language in the standards. And believe it or not, test questions will test you on that. So, yeah, you ready? So let's check it out. In the AICPA professional standards, the word should indicates a presumptively mandatory requirement from which you may depart from in rare circumstances. It's not an interpretive suggestion. It's not an unconditional requirement, and it's not a recommendation that has no authoritative status. Number 2 is kind of dumb. Interpretive publications include all the following except what? Journal of Accountancy is a magazine, so that's not interpretive publication. Stupid question. So that's a quick and easy section. Not a whole lot to it, but there's some important points being made for sure. This is an important section. Now, take note in this section. For some reason, I don't know why, these test questions on this section tend to be missed on the exam 1 in here, and or exam 2, 3, or 4. And they'll show up on every exam because all of our exams are comprehensive. So take special note of this section just because for some reason it doesn't always click and the exam questions get missed. So don't ignore this section. It's important, and I don't know why we missed some of these, but so here we go. These are our quality control standards. So you got financial statements. The auditor has an opinion on those with their audit. And then you got quality control standards that kind of govern the audits. So you just have these levels of assurance, right? So an individual audit engagement is governed by generally accepted auditing standards. A firm's portfolio of auditing engagements is governed by these quality control standards. So there are rules for all the auditing engagements that a firm does. They have to follow these quality control standards regarding all their audit clients and audit engagements. So these would apply to attest services, not tax services or consulting services. So here we're trying to obtain reasonable assurance that the engagements are performed in accordance with GAAS, right? So our audit's going to make sure that the financial statements are presented in accordance with GAAP. Quality control standards are going to help us determine that our audits are performed in accordance with GAAS. So I guess now we need standards to make sure our quality control standards are, got to end somewhere though, right? So that's the deal. It's kind of like we're auditing our audits in a way. And I think we talk about peer reviews in a later section. No, we mention it here. 6 elements of a good quality control system. And these can be tested and will be tested. And this number 1 is the one I highlighted in green because you will see this question probably. So we need good leadership and good leadership responsibilities for quality. We need a good tone at the top. All right. Good tone at the top is never the wrong answer, right? That is always important. And standards will always make an argument that if there's a good, strong tone at the top leadership, that trickles down into all of the other areas of the business. And it's very important that there's a good tone at the top. You've got crappy upper management that everybody hates or nobody respects. Think about the problems that flow from that, right? If you have an unethical upper management, the lower level people are going to be like, well, they're dishonest. We might as well be too and look out for ourselves, you know. So good tone at the top is very important. And that's the number 1 listed here for a good quality control system. So we need ethical managers. We need ones that are respected. So that's very important. Now, dropping down into just an individual audit engagement, we'll have the lead engagement partner taking responsibility for the overall audit quality. So, good tone at the top would affect the audit if we're just looking at that more narrow idea instead of just the entire company. Right? Okay, so that's important. Relevant ethical requirements. So this standard of quality addresses things like independence that we've talked to death about. So, you know, you might want to obtain written confirmation of compliance with independent requirements from everybody, at least annually. And that would be a good quality control thing to have in place, right? The third one is acceptance and continuance of client relationships and engagements. So assess each engagement as part of your quality control procedures. And you would only undertake those that you could competently complete. That would be a good quality control procedure to have in place, obviously, right? So that's addressed here, but this would also address things like don't associate with clients who have management that lack integrity. You don't want to be associated with those types of people. And maybe things like checking their credit rating, checking their reputation, checking them out before you accept them as a client. You don't want to be associated with a bad client. So all that would fit into that third category there. HR, I mean, y'all know what HR is. I didn't really know what to type out there, but, you know, it's just good hiring. You know, hire people who are competent. Make sure you assign work appropriately to those people as they can handle them, right? Maybe good performance evaluations in place. Make sure they're continuing professional education. Make sure they're getting good continuing education opportunities, things like that. Any of that would fit into the HR standard there. Engagement performance, you know, things like making sure things are done at a high level, things are properly supervised, things are properly reviewed, that kind of thing. Monitoring, you know, making sure that controls are monitored so adjustments can be made to keep them working effectively, but also things like, here's a good place to mention peer reviews. Peer reviews is where one CPA firm reviews another CPA firm's compliance with their quality control system, their auditing standards and things like that. So members of the AICPA have to have a peer review every 3 years. Just kind of review each other to make sure everything's looking good. Lots of little checks involved with auditing, right? And also, as part of this whole quality control thing, firms should have a policy for resolving any differences of opinion. I think we've mentioned that before, and we'll mention it again. But that would be part of the quality control system. So, quality control system should relate to all aspects of the firm, right? Deficiencies in the quality control standards or non-compliance with the quality control standards wouldn't necessarily mean that you didn't comply with the generally accepted auditing standards. But it wouldn't be a good thing to not comply with those quality standards. They're in place there to hopefully have a positive impact on the work that you're doing. So yeah, don't ignore this section. Let's look at some of I thought the questions here were super easy. They're just kind of definitional type things. So I don't guess they're worth really looking at. It won't take long to look at them though. Number 1 says, which of the following actions should a CPA firm take to comply with the AICPA's quality control standards? Do they need to establish procedures that comply with the Sarbanes-Oxley Act? No, not necessarily. That's just for publicly traded companies. Do they need to use attribute sampling techniques in the testing internal controls? Well, that's certainly a very narrow thing to tell them to do. So no, that has nothing to do with quality control standards. Let's get more into the audit stuff. Same with C, considering inherent risk and control risk before determining detection risk. This is audit-specific stuff that we really haven't talked about yet. But what about D? Obviously, D is going to be it. They need to establish policies to ensure that the audit work meets applicable professional standards. That would obviously be a quality control thing, right? That would fit into these types of things. Engagement performance, I guess. So, 2, CPA firm would be reasonably assured of meeting its responsibility to provide service with professional standards by doing what? Obviously, it's going to be this. That's what we're talking about, right? But would you be able to answer that if it was out of the context of this section? I don't know. It's subtle, right? Because you got to read carefully. CPA firm would be reasonably assured of meeting its responsibility to provide services that conform with standards. So that's the quality control thing, right? Adhering to generally accepted auditing standards would be, this may not be the best question ever because I feel like I could argue for A or B. So I don't feel like this would be a CPA question because it's just too easy to argue with. But if you do look close enough, to provide services that conform with professional standards, you could say, what are you talking about here? Well, you're talking about GAAS here, right? So adhering to GAAS wouldn't be something that would make it reasonably assured of meeting your responsibility to conform with GAAS. I guess you could argue that. So it's not the best question ever. Let's bounce down to 6. It's about the best one here, honestly. How should differences of opinion between an engagement partner and quality control reviewer be resolved? This is always a good answer for things like that. Follow the firm's policies and procedures. And really the only logical one here, but it's a good point being emphasized, and that's why I wanted to look at it. You know, sometimes that's where you want to look is, well, let's see what the firm's policy and procedure is for this type of thing. You know, you're not going to have industry best practices on this, and not everybody's going to have an audit committee, and this is nonsense. So, yeah, that's kind of a good point being made here. All right. Moving along. On quiet tonight. Keep going. Okay. Overview of the audit process. Overview sections are very broad and things you'll see again in the content to follow. So they start by talking about engagement planning. Well, pretty much everything from our reading in week 4 is going to be about engagement planning. So we're going to see it pretty heavily. But as a preview, we're going to be seeing about what we need to do when we're deciding whether to accept an engagement or continue an engagement that's already one we've been doing. As part of planning, we're going to assess risk, and we're going to look for areas of risks where material misstatement could occur. We're going to try to figure out staffing and supervision of this engagement. And we're going to come up with a plan, an audit program that gives us an idea of the nature of the procedures we're going to do, when we're going to do them, and how much we're going to do. And there's another one of these very common phrases: nature, timing, extent of auditing procedures. So those are some of the things we're going to do in planning. Like I said, our entire week of reading this time is going to be about audit planning, engagement planning. So it's very broad what we're just looking at here. But yeah, we're going to do this. This is really kind of an outline of what we're going to do over the next several weeks. So we got planning, internal control we're going to consider. So we're going to obtain an understanding of internal control. And document our understanding of it. Then we get into our actual substantive auditing procedures where we're going to gather evidence. And this is the point in the audit where we're actually getting evidence to try to verify statement elements, financial statement stuff, and look for errors and look for things like that. So as part of that step, we're going to do analytical procedures where we're just doing a bunch of ratio crunching and looking at trends and looking for just things to jump out at us. And then we're going to do heavier tests of the balances that are on the balance sheet. And we're also going to do tests of some of the transactions that occurred during the year that led up to those balances. So those are our tests, and we've got a lot of content that discusses all of that. And then finally, we're going to issue a report. So this is almost like a table of contents for the stuff that's about to follow in the text. Not a whole lot to take away on this one yet. But look at number 1, because here's that important phrasing again. Principles underlying an audit conducted in accordance with GAAS state that sufficient, appropriate audit evidence, there it is again, is to be obtained through designing and implementing appropriate responses. We're not ready to answer this, honestly, but I just wanted to kind of point out again, there's that same phrasing that we'll see over and over. Don't worry about this question yet, though. You're really getting ahead of us with this question. Same with 2. It's a really general question that'll be easy to answer with a little more familiarity. So we'll hold off on this. These questions they threw in the overview section were a little ahead of us. So we'll just move along. So then they're going to give us a little preview of different types of engagements that we as CPAs could undertake, which we'll cover in detail as the semester goes on. We talked about audits, so we don't have to really mention that again, but other engagements that we'll talk about this semester. So we've got the statements on standards for accounting and review services, which people refer to as SARS. These apply for assurance services offered for private companies, but they're less than a full scope audit. So these are things you could do for a private company that don't need the gigantic full scope hardcore audit. You could have an engagement where you're just doing a compilation. Very simple. You're just putting their financial statements together in the right format. You're not giving any assurance at all. You're compiling them, and you're going to issue a compilation report, and that report's going to specifically say, we're not doing any kind of assurance on this. So that's a compilation. We'll talk about that in detail way later in the semester. This second one's kind of a new thing that they specifically mentioned in the standards now, a preparation engagement. That wasn't a thing that I learned about back in the day. In fact, that just now got into the text this year. It wasn't in there last year, actually. So a preparation engagement is preparing financial statements and not issuing any report or providing any assurance. So that's that we'll talk about later. And then a review is less than an audit, but you are giving some assurance at this point. You're doing a limited amount of tests, and you're going to provide a limited amount of assurance. You're going to say, nothing came to our attention when we did all this that would lead us to believe that anything wrong. That's called negative assurance. With an audit, you have this very high level assurance where you say, in our opinion, these financial statements are presented fairly. With a review, you're giving negative assurance. You're just saying nothing came to our attention that would indicate that this is wrong. Right? We'll say it better than that, but that's essentially what you're doing. So that's the difference in positive assurance versus negative assurance. So you have an audit, high level of assurance. In our opinion, presented fairly. With a review, a moderate level of assurance. Nothing came to our attention that causes us to question this. Compilation or preparation, no assurance. You're saying, here they are. Take them for what they are. So again, very much an overview of things we'll see later in detail. So that's all governed by the review standards, SARS. Then you have another set of standards, the statements on standards for attestation engagements. These are going to govern some kind of oddball things like an examination on agreed upon procedures engagement. So here you're given assurance about something other than financial statements. So there's an examination where you actually provide an opinion on whatever the subject matter is or the assertion is. Review, just like above, you're giving negative assurance on whatever you're speaking to. And agreed upon procedures engagements, very specific. I'm doing this, and based on this, give assurance based on these procedures. Here were the findings from my procedures. So we'll talk about all of those later on in the semester. So this is just an overview of all that. And then they mentioned that we need an engagement letter, and then we got a whole entire section on engagement letters later too. So a lot of repetition coming. So if they make a point now that we need a written engagement letter for engagements to audit, to review, to compile, any of that. We need to establish an understanding about the services that we're going to render. Cover a lot of things that we'll talk about in the engagement letters chapter later on in this semester. So not a whole lot of high-level stuff here yet, but I think someone asked the question earlier in the semester about what an attestation engagement is. So this gives a very good definition of attestation here. An attestation engagement is one where a CPA is engaged to A, issue a written communication expressing a conclusion about how reliable something is that they're reporting on. The reliability of some written assertion that someone else has responsibility for making. Management is making an assertion and we are attesting to it. So there's a very good definition of attestation right there. It's not tax advice. You're not testifying as an expert witness and you're not assembling pro forma financial statements. Those are very specific things. Attestation is a very broad thing. An audit is a type of attestation engagement where we're doing a very specific thing, right? So, nice definition there. And, you know, here, this certainly goes along with the content from this chapter. An entity engaged a CPA to determine whether a client's websites meet defined criteria for standard business practices and controls over the integrity of transactions and the protection of information. So that's something we could be engaged to render an opinion on, right? So doing that, what standards would that fall under? We mentioned that the SSAE will govern opinions on things other than financial statements, right? So there you go. The preview of things come as well, though. All right. Questions, comments? Just along for the ride tonight. Pretty easy content tonight, right? Shoot, we're almost done. I knew this wouldn't take long tonight. All moves pretty quick. PCAOB responsibilities. Again, right? We've already talked about PCAOB a little bit. They are the ones who have responsibility for the auditing of public companies, right? And they were created as part of the Sarbanes-Oxley Act. So Sarbanes ended the days where the profession regulated themselves regarding publicly traded companies. All of this came as a result of Enron. I'm sure y'all heard all of this history. So the PCAOB was created, Public Company Accounting Oversight Board. Right. Sometimes I forget what things are standing for. I think that's right. So their responsibilities all have to do with public companies being audited. So the public accounting firm that audits any publicly traded company has to register with the PCAOB. And then they have to be inspected. Firms that provide audit reports for 100 or more companies are inspected every year. They provide audit reports for less than that every 3 years. PCAOB is responsible for setting standards for the audits of public companies. When they first came into existence, they just adopted the AICPA standards, and then they started tweaking them. And then they're responsible for enforcing and funding. But you know, back to this inspections, the way that works is they select audits to review papers, and they interview engagement team members, and they're just making sure that the audits are complying with PCAOB standards. They're auditing the audits. But yeah, Sarbanes is what kind of created all this. So Sarbanes-Oxley gave the authority to PCAOB. And we'll see time and time again these requirements of Sarbanes, but here's some of the highlights of it here for sure. It established pretty strict independence requirements for auditors of publicly traded companies, and we kind of already talked about that. It really limited the non-audit services that they could provide. There's some things that are always prohibited for auditors of public companies to do for their audit clients. Otherwise, independence is impaired. They can never do things like bookkeeping for their audit clients. They can't design financial information systems. They can't do any appraisals or valuations or actuarial services for publicly traded company audit clients. Can't do that. Earlier tonight we talked about those Department of Labor rules where you could do actuarial services for those employee benefit plans, but PCAOB doesn't allow it for public company audit clients. You can never do any management type things or HR type things. You can't be an investment advisor. And, there's a whole lot of things you can't do. Sarbanes established a rotation of the audit partner and review partner. They don't want the same one doing it every year, like forever. They established that 1 year cooling off period. I remember we talked about the rotation. It's like 5 on, what was the rotation period? 5 years on, 2 years off, right? 5 on, 5 off. The lead and concurring audit partners have to be rotated off every 5 years. That's what it is. Yeah. I think we saw that last week. Should have made note of it again here. But yeah, they mentioned that 1 year cooling off period when you take a position with a key employment position with an audit client. Remember that from last week? That came from Sarbanes. But the big thing about Sarbanes that I think shows up most often in test questions is they're big on the audit committee. So you got the audit committee approving any non-audit services that aren't automatically prohibited. And the audit committee has a lot more responsibilities too, which we'll see in later sections. But audit committee is a key thing for the Sarbanes-Oxley Act. They have a lot of responsibilities. Another key thing that shows up in test questions is this. Executives are required to now take responsibility for the accuracy of financial reporting. CEO and CFO have to specifically sign and certify that everything's fine. And that gives them, that puts them on the line in a legal sense. So it establishes some legal ramifications to that puts them kind of on the line for things. So there's a little more on Sarbanes. Again, we'll see it in more detail later, and keep mentioning the same things over and over again, honestly. Questions? Oh, there's a question about how you rotate the audit partner right there. Sarbanes imposes a mandatory rotation for the engagement partner and the quality control partner, which we typically call the review partner. How long in total is the partner allowed to serve as the engagement partner or review partner before someone else must serve in that capacity? So it's 5 years on, and then they got to be 5 years off. So then they come back. So there you go. That 5 year thing. Number 2 says under Sarbanes, which of the following is not a stated responsibility of the PCAOB? Do they have to conduct inspections of registered public accounting firms? Yes, we said that they, the firms have to register with the PCAOB, and then the PCAOB will inspect them, reviewing their review papers and things like that. Does the PCAOB oversee the registration of public accounting firms. They do, I just said that a second ago too. C says the PCAOB issues accounting standards that must be followed. So pay attention to the wording there. They don't issue accounting standards, right? That's the FASB. PCAOB issues auditing standards. So C is the one that's not one of their responsibilities. And then D kind of builds on C. They issue auditing standards. So there you go. Two is a pretty good question. They kind of repeat the same content in number 3 here, though. So, same exact thing, honestly. We do all this except establishing accounting standards. So, same old thing. I don't know about 4. I don't know if you get a question like this on the CPA exam. That's a little nitpicky. It says, how often should a PCAOB inspect a registered public accounting firm that regularly issues audit reports of 50 issuers? So we said greater than 100 every year, less than 3 years, right? That just seems a little nitpicky of a question. So, but after reading that question, I went back to the notes and I added it in there just in case it was important. One of those things that you automatically will remember after seeing it this one time, and it's in your brain forever, probably. So that's not a bad thing. That's why it's good to practice as many of these questions as possible. Remember the day that you answered that or didn't know the answer to it. You'll remember. One more section and we're out of here. PCAOB on quality review. So back on the quality review stuff. So, we talked about quality stuff just a few sections ago, but now we got PCAOB's stance on. PCAOB requires an engagement quality review and concurring approval of audit report issuance for all audits of issuers. That's the practice sentence. Which is on my notes, but it looks like I fixed it on the page here. So on my written notes, I have that as a horrible sentence. I guess I didn't like it. I fixed it on here without printing out a new one. PCAOB requires an engagement quality review. That's really a takeaway from what I just said. So this engagement quality review that they're requiring, the purpose is to evaluate, and highlight in green the key takeaways from what we're saying here. The purpose of this engagement quality review that the PCAOB requires is to look at the significant judgments that were made and the overall conclusions that were reached. That's really their key focus there. That's probably the most important thing here. They then talk about what a qualified reviewer needs to have associated with them. It says they need to be a person associated with a registered accounting firm. That could be within your own firm or outside the firm. Then there's more stipulations if it's a reviewer from inside your firm. Person serving as an engagement partner then during any of the 2 preceding audits can't be the reviewer. The 2-year cooling off period there. They must be competent. Who doesn't need to be competent, right? That's not something to memorize. Anybody has to be competent. They also have to be have integrity and objectivity. So I highlighted in green, they do need to be independent of the client. They're going to review some documentation. They would not express approval if they found that the team failed to obtain sufficient appropriate audit evidence, or if they found that the team did not issue an appropriate overall conclusion. I feel like that's an obvious statement right there, right? I mean, what do you think they're checking on? So I can't imagine a test question that would really throw you for a loop on that. Of course, they wouldn't express approval if they didn't get appropriate audit evidence or reached a wrong conclusion, right? So I just feel like this is a pretty obvious section. I did put a little star by this one. The firm can't give the audit client permission to use the report until the engagement quality reviewer provides their approval. In other words, you got this reviewer making sure that there's no significant deficiencies in the engagement. It's really what they're looking at. Sufficient deficiencies in engagement would be things like lack of independence, insufficient audit evidence, inappropriate overall conclusions, things we just mentioned, right? Obviously, there needs to be sufficient documentation. That's always a right answer too, right? Everybody should document everything. So I think we have some exam or chapters later on that's all about documentation. And we pretty much can streamline that by saying everything should be documented. Why wouldn't it be? Right. So listing all these things that need to be documented. And it's just like, document it all. Test question speaking, it's like everything should be documented. Those are easy sections. And then some differences between the PCAOB rules for quality review versus AICPA ones for non-publicly traded company audits. PCAOB absolutely requires this to be a thing. AICPA doesn't require it. And there's no cooling off period. You see the list of things that AICPA doesn't require. So I don't know if that's worth committing to memory or anything. Just maybe note that the PCAOB does require this engagement quality review. So, for a non-issuer, a non-publicly traded company, this engagement quality review is only performed if maybe the firm policy is that should happen. It's not required, but for PCAOB audits, it is required. I guess to carry that a step farther, it's actually required for a private company audit if that report's going to be widely distributed. But yeah, all work should be reviewed by others no matter what. This engagement quality review that we're talking about specifically here that the PCAOB requires, it's an objective review of this stuff rather than an engagement partner looking at things, kind of like they normally do in an audit. It's not somebody giving it a second look. This is an objective, let me make sure this is all fine type thing. So it's a special thing here. These questions are worth looking at. Honestly, my notes to these are kind of simple. My notes are simple, obvious. 3 and 4 were a little overly specific, kind of like that one a second ago, where it's like, if you audit 50 of them, how often do you have to do this? I felt like those were too specific. To me, I think number 3 here is a little too specific with all these 10-year, 5-year documentation type things. And characteristics of the reviewer seem like maybe 4 is not quite as nitpicky specific as the other. It kind of is too. So keep that in mind. Some of these are just a little too specific to be a good test question, in my opinion. Okay. Five highlights a good point that may not have been evident from the text material. So let's look at it, just to kind of put a little more words with it. To evaluate, this engagement quality reviews, all about kind of auditing the audit. To evaluate the significant judgments and conclusions of the engagement team, AUD auditing standards, the engagement quality reviewer should do what? Should they make inquiries of client personnel and perform analytical procedures? No, this is not what they're doing. They're not re-auditing things. They're not going to have interviews with the management of the company that's being audited. That's not what they're about, right? Same with B. They're not going to do tests of details. There's analytical procedures again. They're not corroborating. They're not doing audit work again on the client. Same with C. They're not making inquiries again of client personnel. But D is what they would do. They're going to have discussions with members of the engagement team. They're going to have discussions with the engagement partner. And they're also going to look at the work papers of the audit. They're going to look at the engagement documentation. So I think 5's good for just kind of putting a new spin on what exactly are they doing. That's what they're doing. They're looking again for, were the judgments that the engagement team made okay? And was the overall conclusion that they met or reached okay? And things like, were they independent? That kind of thing. That's it, isn't it? Task-based simulation on there. Unless y'all have something y'all want to talk about more or any specific questions to look a little deeper into, I can't think of anything else to say on this week's stuff. All pretty straightforward, kind of broad, right?